I think the market's consolidating and maybe trying to get direction from what the market does, because we did gain 28% from the April lows. We got to digest that. Now we're in August, like the dog days of August, where liquidity is lower. And I think that we're still holding our breath because we're in a period where the Fed isn't going to make an interest rate decision until September. So some of the key macro is kind of on hold. So I think markets are wait and see, but I'd say that pullbacks have been shallow. I think that's everyone's playbook, that August should be weak and September down. But precisely for that reason, with the economy being stronger than people realize, Bitcoin made a breakaway move on July 9th. It has led the S&P for the last 5 years by almost 1 month. I think our year-end target is probably low, because I think we could do 6,600 this month. I think this is the month.
This month?
Yeah, I think we're going to have a breakaway move in the S&P this month.
Right now, the market feels stuck. After a huge 28% jump since April, the S&P 500 has hit a pause. Trading is slow, and the usual buzz is missing. Investors are wondering, is the rally over? Has the market lost its energy? Prices look high, and wild swings from meme stocks have some people worried. The Fed is quiet about interest rates until September. August is known for slow moves, and September often brings setbacks. Some think the market is tired. Others say it's just catching its breath. Everyone is waiting, watching, unsure what comes next. But Tom Lee sees something different. He says this pause isn't a stop sign. It's the market changing gears. The quiet now is the calm before a big move. Lee believes the market is getting ready to push much higher. He says the recent gains were just the start, and a powerful rally could begin any day now. This isn't small or slow. It's the kind of shift that will surprise a lot of people. If Lee is right, the biggest rally of 2025 is about to take off, and it will be unstoppable. So pay attention. The market is ready to roar again, and this time it won't hold back. Now let's watch clips from Tom Lee's interview to gain more insight. Please don't forget to like, subscribe, and enable notifications for more in-depth content. Thanks for joining us again. Enjoy the rest of the video.
I think the market's consolidating and maybe trying to get direction from what the market does, because we did gain 28% from the April lows. We got to digest that. Now we're in August, like the dog days of August, where liquidity is lower. And I think that we're still holding our breath because we're in a period where the Fed isn't going to make an interest rate decision until September. So some of the key macro is kind of on hold. So I think markets are wait and see, but I'd say that pullbacks have been shallow. I can attest to it from our conversations with clients. We can see it measured in surveys like AAII, where there's stubborn bearishness net still. And then we did the rounds, Fundstrat did the rounds with a lot of our institutional clients the last 2 weeks. And I think folks are very cautious, which is actually good for stocks. They're cautious because, of course, markets have moved, and our clients tend to be valuation sensitive. But I think adding to their frustration is that during that April downturn, many were selling their best names because they were trying to get defensive, and then they haven't fully reloaded yet. So I think that's why there's still room for stocks to go up. So really at the core, any fundamental investor is going to use valuation as really one of their anchors. Is that the stock market had 6 stress tests in the last 5 years, from COVID to the bullwhip supply chain, to the fastest inflation cycle in history, to the fastest Fed hikes in history, then to the Trump tariffs, and then, of course, U.S. bombing nuclear facilities of Iran. Those are things that could cause catastrophes for earnings, but instead the S&P earnings have actually grown. So I think we're in the process of re-rating the S&P. So I actually think multiples will continue drifting higher.
Okay.
I think the dearth of IPOs over the last 5 or 6 years has shrunk the number of stocks in the U.S. stock market. There's not even 5,000 listed stocks anymore. Well, I think like a Circle is a good example of scarcity, because that was the best IPO really in 5 or 6 years, but it's a blue chip company. They are the biggest compliant issuer of stablecoins in the U.S. and it's growing prodigiously. So in a way, it makes sense that it went from, a $20 IPO to 200 today, because it's scarce. It's just as scarce as a Palantir, but with a different market size. And I think that these quality names like a Figma represents that same scarcity, because we actually have a shrinking number of stocks out there. There's a lot more privately held companies, but the public market's small. And then if you think about it, there's every year dividends are paid on the S&P. That's getting sitting on the sidelines. There's $7 trillion cash on the sidelines. People make income and they're saving 10%. If they don't buy stocks and they haven't been able to buy homes, this cash is piling up, and that's why it probably goes into the stock market.
Okay.
I think when people cite these numbers, and I've also heard Max Myers say that like 2 stocks are bigger than like Tokyo's entire stock market.
Max is going to love the shout out, by the way.
Yeah.
Anyway, please go ahead.
That we have to think about the earnings contribution. NVIDIA is producing incremental earnings at an incremental margin that tells you it's an incredibly scarce company. They're not making enough chips, and they are the center of the AI revolution. So I'm not surprised it's the biggest stock. I think from an earnings growth contribution, it's so big that those previous measurements aren't accurate.
Okay.
Well, I think there's consumer preferences could be shifting. Because you remember, post-COVID, there was this boom in eating out and dining experiences. And we shouldn't say that that's a permanent change, and that's why you're seeing some of these. I don't think consumers are over-levered. To me, that's the sign of a peak in consumers because they can't amplify their spending. That's what the banks are going to tell you. And if you look at the Fed's debt service ratio, we're still below COVID level. Of course, at any moment there is, but really in aggregate, you can't get a levered consumer until you have a housing boom. So consumers might be on short-term credit, some of these being stressed, but that's very different than us actually peaking really from long-term credit borrowing in a binge. I mean, I think our year-end target is probably low because I think we could do 6,600 this month. I think this is the month.
This month?
Yeah, I think we're going to have a breakaway move in the S&P this month.
Tom Lee systematically dismantles the bear case. On valuation, he argues the market has endured 6 massive stress tests since 2019. COVID, supply chain chaos, historic inflation, the fastest Fed hikes ever, Trump tariffs, and even geopolitical tensions. Through it all, S&P earnings grew. This resilience, Lee contends, means the market deserves a higher valuation multiple re-rating than historical averages suggest. Multiples, he believes, will continue drifting higher. Now, people worry that speculation is out of control. Tom Lee sees something else. He points to a simple problem: scarcity. There are far fewer stocks to buy. Years of weak IPO activity mean fewer companies go public and more are staying private. This creates a shortage. When a truly strong company finally lists, like Circle, a big player in stablecoins, everyone definitely wants it. And when huge demand hits tiny supply, prices soar. Lee says this isn't wild betting. It's basic supply and demand, so it makes sense. Then there's the fear of concentration. Just a few giants dominate the market. The numbers are scary. Lee knows this, but he argues, look at the earnings. Take NVIDIA. He says it's incredibly scarce. It makes money that no one else can right now. Each new sale adds a huge profit. It's the engine of the AI boom. Its massive size and growth power the whole market. Because of this, Lee believes the old ways to measure concentration are no longer effective. They miss the real story of these companies' strength. This isn't a bubble. It's the market paying for unmatched earnings power. That concentration reflects real value, not just risk. Let's watch more clips from Tom Lee's interview to gain more insight.
I think that's everyone's playbook, that August should be weak and September down. But precisely for that reason, with the economy being stronger than people realize, Bitcoin made a breakaway move on July 9th. It has led the S&P for the last 5 years by almost 1 month. So I think a breakaway upside move in the S&P is coming.
All right.
Yeah.
That's your call?
I would say that's our base case, yes.
Starts next week.
I mean, I can't give you the hour and the day.
You said it might start next week.
But that's 5 days.
You want to put yourself out there by all means.
Yeah, but I think it starts within the next week, yes.
Okay.
Really, since 2020, the dips have been shallow unless we have structural problems. I would say it's a good sign that investors are cautious, which is what we're finding. And as Laura was mentioning, there's tariff concerns. People just want to get through and see what tariff impacts there are. But we also know that consumer expectations around inflation are cooling. I mean, it's prevalent in the UMich surveys, the Consumer Conference Board, and also the New York Fed. So I think the Fed correctly is being patient, but that's a catalyst, because if we think there's cuts in the fall, that's good for stock.
Tom, what about a big, beautiful broadening this market? Does that come?
I think we're primed for that because the equal weighted S&P PE is 16.9 right now. It was almost 18 on the eve of COVID. So the market has gotten cheaper after facing all these stress, even at an all-time high. So is the case for stocks having better earnings performance there? Yes, if the Fed starts cutting and we're onshoring and the ISM's been below 50 for almost 30 months now, we haven't really seen a peak of a cycle until ISM breaks above 50 for a sustained period. That's earnings broadening. Yeah, and that's great. That would be great for industrials, financials, and as I quietly say, small caps. But then we should think of it in sort of second order effects. The first is that the earnings growth of the median stock has actually been very good. So, and we saw it in earnings season because 83% are beating, and now the stacked earnings 2Q versus 2Q is over 12%. That's not just the Mag 7. But the second is that we know that the AI is progressing at a pace that it's delivering real benefits to companies. So companies are now going to see the benefits. I can't point to what it'll be, but it's probably margins. And so that's a story that should be broadening earnings performance.
Well, depending on the impact of tariffs.
Correct. And tariffs are things that are well telegraphed and socialized. And as soon as markets view it as one time, we will actually look through those.
Yeah,
but let's keep in mind, tariffs are going to create winners and losers because the companies that imports are 10% of our economy, and the companies that are highly reliant on imports are going to have effects that they have to reprice their business and margins. But that, if someone said that should take down S&P earnings and the S&P 500, they're overlooking that the S&P is a broad set of companies.
So, where does this leave us? Tom Lee is unequivocally bullish. His year-end S&P 500 target sits at 6,600, but he readily admits that might be too low. He believes we could do 6,600 this month, and we are going to have a breakaway move in the S&P. Tom Lee's prediction is bold. It goes against what usually happens in the market. August is normally a slow month. September is usually worse. Lee knows this is what everyone expects. But he believes bigger forces will overpower these seasonal patterns. First, the real economy is stronger than people think. Worries about tariffs and nervous headlines hide this strength. This hidden power could surprise markets soon. Next, look at Bitcoin. It jumped sharply higher on July 9th. For the last 5 years, Bitcoin's moves have come 1 month before stocks follow. Its rise now signals stocks may surge very soon. Then there's investor fear. Lee sees deep caution everywhere. Fundstrat's meetings with big investors showed this. Many are frustrated. They sold their best stocks during April's market dip. They moved to cash for safety. Now they haven't bought back in fully. Lee says all this unused cash must go back into stocks. It will push prices higher. So, there's still room for stocks to go up. Finally, the market is changing how it values stocks, and this rating is real. The S&P 500 survived huge tests, a pandemic, supply chain chaos, historic inflation, and tariff hikes. Its earnings kept growing through all of it. Now investors accept stocks that deserve higher prices. This rating isn't finished. It keeps supporting higher stock prices. However, Lee doesn't see a narrow, top-heavy rally forever. He's primed for a broadening. But why is he so sure? Look at the stocks outside the giants. The equal-weighted S&P 500 trades at a PE of just 16/9. That's cheaper than before COVID hit, when it was nearly 18. And this is happening while the market sits at all-time highs. Earnings tell the same story. Last quarter, 83% of companies beat expectations. Overall growth topped 12%. Now, this strength isn't just in tech, it's been in many other industries too. Lee sees a shift coming. AI's power won't stay locked in chip makers forever. Its benefits will spread. Factories, banks, retailers. They will use it to cut costs and lift profits. Margins could rise across the economy. Then there's the Fed. If it finally cuts rates, that could be the trigger. Cheaper borrowing costs would help smaller companies breathe. So, earnings growth should widen fast. This would rescue forgotten sectors. Industrials could shine. Financials might rally. And crucially, small caps, those long-suffering stocks, might finally catch up. They've been left behind for months. Investors are frustrated. Lee believes their pain could turn to gain. Lee also acknowledges near-term risks like tariffs. He doesn't ignore them, but he calls these hits manageable, likely one-time events. Once markets grasp their real impact, they will move past them quickly. What truly drives his view? 4 unstoppable forces: earnings staying strong, investors hoarding cash waiting to buy, stocks being revalued higher, and the Fed soon cutting rates. These pillars hold up his bullish stance, and he believes tariffs won't break them. His final time-sensitive prediction cuts through the August haze. He thinks it starts within the next week. Yes, Lee is saying, forget the seasonal playbook. The ingredients for a powerful, broad-based market breakout are in place, and the fuse could be lit imminently. Now, the hated rally, fueled by skepticism and waiting cash, is set for its next big blast-off. Thanks for watching, and don't forget to like and subscribe.